Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to look at the EIA report and do our normal overview, refined products and exports. So now just kind of jumping right in, we're just going to start with Hurricane Sally because we want to see, what is happening, what is going to be the total impact overall. And you can see that it really shifted east, and it's really going to land right within that Alabama, Florida Panhandle region. So the storm surge is going to be relatively large based on what the early indications are, but which is obviously going to be problematic and devastating for some of those people within the region. So hopefully everyone is safe and was able to evacuate. But in terms of the actual impact to oil and gas, it will be minimal. We've already had refiners say that they're going to cut the amount of employees that are there, but they're going to still maintain a skeleton crew. You should see some refiners take down some of their runs, but in terms of actual shutdowns, we won't really see much. And now just to give a kind of a brief estimate based on what the numbers are so far, you can see the amount of evacuated platforms, rigs evacuated. So it's not the same as we saw with Laura, but obviously there's still going to be a little bit of an impact where at this point, the estimates are about 27% of oil loss and 28% of gas, with oil shut-ins accounting for about 497,000 barrels. So we'll talk about that when we look at the total production numbers that we had so far this week. And then when we just look at hurricanes in the Atlantic, just to give you an idea of how busy it is right now, this will last really through October when you consider kind of where the meat of hurricane season, really falls. And you can see that just the activity. So these are things that we're continuously watching. Some of them will kind of peter out, shift, but we're always looking and making sure just to understand, how is this going to change the way shipments are coming, imports, exports, and then as well as just inherent production. So just jumping right in. So we had a relatively nice draw, so it goes both ways. So it was a nice draw. We had a pull of about 6.5 million barrels a day out of storage. Again, including the SPR, because the SPR had about 2.2 million barrel draw. So we have to look at it on a holistic level, but the inherent drawdown was still pretty good. We had a dip in imports and we had a dip in exports. So those kind of balance themselves out when you consider the fact that we did have a crude draw. Now, this is also with what we were talking about last week, where we were expecting anywhere between, we have about 11.1 million barrels a day of production, and this comes in at about 10.9. So we should get a little bit of an adjustment just because we had Sally coming in, which is going to take about 400,000 off. And we were sitting at about, this is probably missing anywhere from 100 to 200,000 barrels. So we should be between 10.7 to 10.6, 10.7 this week into next week, just based on Sally's numbers and how they're calculated based on where they thought we were going and then what is been coming off. Now, again, just as long as there's no damage, we should see most of this production come on by either the end of this week during the weekend or beginning of next week. And so we should get a little bit of a normalization. But it'll hit PADDIII the most, which had another draw of 2.78 million barrels, which we'll start to talk about a little bit more. So now we're going to look at the total inventory. So we're still including the SPR just because we still have a little bit more coming out. Again, the 2.2 is getting us closer to the kind of the bottom, but you can still see that we remain near all-time highs going back to 1991. But the more important one as we go forward is going to be where are we excluding the SPR in terms of what's in commercial storage. So we dip back below that 500,000, which is just a 500 million, which is a number that is watched pretty closely. And here you can see that we're still trending in the right direction, but at the seasonally adjusted all-time highs. The question is going to be when things start to normalize a bit, what are refiners going to do? Because even though we had a big walk back in refinery utilization rates, which we'll talk about later, we still had a net build in refined products, which is a problem when you look at the longer term trajectory of oil demand going forward. And that's when we start to look at the crude oil inventory in PADDIII. And here you can see that we're starting to kind of balance out. And we're kind of going back and forth with some imports that were delayed that will start coming through. We had an increase in VLCCs that have been purchased, which will start to show up in the in floating storage. But again, it's just going to be kind of those timing delays at this point. But in terms of imports, they were down just because your refinery utilization rates remain under pressure, which we're going to talk about in a minute. And we had exports that were down. So it's here we expect this to kind of sit sideways, not get too much in one direction, just as some of the exports start to catch up, some of the imports start to catch up, and we start to kind of offset while we get some of that production coming back online from these hurricanes. Now, just taking this piece by piece, I think it's important to look at where things sit. So on a total import level, we were down about 417,000 barrels a day, which was really driven by PADDIII and PADDIII. With PADDIII, PADDIII is more, PADDIII is just because you're starting to see some slowdowns. We're past that point of driving season, so you're going to start to see a little bit of a decrease in the East Coast, especially with some of the announcements of rollbacks of refinery throughput. PADDIII is more timing, but PADDIII is one where we're starting to see a little bit more of a pickup. That we're right within the kind of the 5-year average. So there's nothing too crazy in terms of where we sit in PADDIII, but that's one to watch as you start to see some of this normalization in just driving demand, which has been impacted across the West Coast when we're looking at some of those forest fires. Runs overall increased 4%. That was really driven, as you can see, from PADDIII. Now, based on, we had about 2.1 million come down. We had damage to about 600,000 barrels of throughput a day. And then we had some processes that were just not going to come back just based on where we are in the seasonal nature. So we're getting pretty close to what we think is going to kind of be that stable number so far within PADDIII. So, based on what we see this week into next week, we're expecting to kind of sit between this 75 to 76% utilization rates. And we're going to start to talk about, later on in the next segment on refined products, why we think those numbers could come under pressure, especially as we get through the end of September and into October. And then implied demand was kind of a balancing act. Distillate was relatively weak, which again is going to come down to, well, what is movement with shipping and rail. So we keep going back and forth, and then gasoline is kind of balancing out as we get ready for the people kind of starting to go back to work. And are you going to take mass transit or are you going to drive? So those are going to be some interesting things coming out when we're looking at gasoline. So looking at floating storage overall, you can see that the floating storage, as we said last week, we were just going to follow that 5-year average. Based on where we see the new purchases, as we've talked about in our OPEC shows, we had OSPs getting cut, so that's increased a little bit of purchasing, and we should see some additional flow coming into the Gulf of Mexico, which will initially be set in terms of floating storage. The problem is going to be, as you have PADDIII refiners maintaining this very low run rate, they're going to have to balance that out with imports and what they're pulling from storage and what they're going to pull from onshore production, which is why we think this number is going to continue to kind of match that 5-year average. And if realistically start to trend above that average, especially as we have additional flow coming through. But again, Saudi, OPEC appreciate the optics of the EIA, and they're going to try to avoid some of these large increases, which is why we're seeing some let's just say larger builds in areas throughout Asia, which is not as easily watched, and you can kind of hide some barrels a little bit easier. But again, this is one that we think is going to manage along that 5-year average. And just looking at that import level, again, it's going to come along with, all right, well, what was the price? Where are refinery utilization rates? So this is one that we think is going to remain well off of that cloud in terms of the bottom level, and just go to sideways, because they're just going to marry with what is refinery utilization rates, what is the pricing complex, and that's going to be an overall overhang on imports into PADDIII. And when we talk about utilization rates, we have to look at what's happened here. So that big dip down is a mixture of between 2008 and 2005, when we're looking at kind of these optics as to what is happening overall. And you can see that we still maintain a very low refinery utilization rate, which, given how low it is, we would have expected to see a much bigger draw out of products. And the fact that we didn't, again, speaks to some of these problems that we're going to see going forward. When we start looking at the different products, piece by piece, we're going to talk about specific headwinds that's going to strike each one. Which, again, even though we've had a nice rally in crude at this point, you have to consider where we sit. So the U.S. dollar is under pressure, which has typically been dollar down, oil up. We have an options expiration coming up, and then we had a big purchase of about 40,000 contracts yesterday, which can help kind of throw things off. This is one where we think crude is going to maintain this downward trajectory, but as we said, 37 was first target, quick bounce, and now we think that there's going to be additional pressure, especially as we go through the remainder of the shoulder season, which we're going to go through in more depth in the next segment as we go through the specific refined products.